Hello everyone, welcome to yet another episode of Market Decoded with Anand. Today we will be discussing upon some of the important fundamentals of options. Before I start, I would like to introduce myself as CA Anand Asija. I am an option seller and a derivative trader. So I usually trade in the lighting segment, meaning I am an option seller. So there has been some risk defined positions that I usually trade in, so that everything works out in my favor. So I have been working in the market for around 7+ years, and I usually do credit spreads, some defined risk. So for me, risk and position sizing comes first, profit comes second. So this is a key to success for all of you as well. So just keep this in mind, and let's start with the discussion now. So before I deep dive into the discussion, let's an important disclaimer. This video is specifically for education content only. It is not to be taken as a trade advice or anything else. It just covers some of the options basics. We will be discussing upon a lot of these things later upon as well, but this should be provided you as a education content only. Secondly, options carry the substantial risk. Trading options involve a significant risk, so you should be exercising diligence whenever you are trading with derivatives, because as Warren Buffett has also said it, these are the weapons of mass destructions. So you can burn your hands, so always be careful while trading in derivatives. And all the example that we have taken within this video, within the slide deck, is hypothetical. So this is not an indicative of any future results. Next is do your own research. Before diving into any of these things, do your own research, consult a SEBI-registered financial advisor, or do your own risk tolerance before you trade into any of these decisions. Alright, let's go into the mechanics of options. So we will be discussing upon pricing, Greeks and strategies basically, and not going deep into the strategies, not going deep onto the Greeks, not going deep into the pricing as well. We will be discussing upon only the basics right now, and then you can let me in the comments that which one of you is more important, and we can make the slide of Nick or next video about that. Alright, so first of all, let's talk about the contract. So before we jump to options, you need to understand what is the contract between the options. So usually whenever any option buyer or option seller usually trades, so there is an underlying contract that executed. So underlying contract requires an underlying asset. So it could be equity, it could be index, like there are Nifty contracts, Nifty index options. Similarly, there could be Reliance index options, Reliance futures. So all of these have an underlying asset. Like for Reliance options, it is having Reliance as a underlying asset. Alright, and similarly for Nifty futures, for example, we are having Nifty August futures, so we have a Nifty as a underlying asset. Nifty future is a contract, a futures contract of Nifty. Alright, so second is expiration date. So expiration date is usually, like for August, it would be the last Thursday of the August. Similarly, we have weekly options as well. So weekly has, for example, Nifty has a Tuesday expiry. So each Tuesday we have an expiry. Of course, there has been some changes where we usually encounter that there is Monday, there's a holiday, then the shift of expiration date. So we need to follow the NSE calendar to know that okay, this is the expiration date of this weekly contract, and this could be the same case for monthly as well. So we need to keep looking out for the expiration date as well. Now third is about strike price. So usually a strike price has been demarcated already, like strike prices for Nifty, like right now it is being traded around 23,600 levels. So we have a 50 points as a strike price differences between each of the Nifty strike levels, right? For example, today Nifty is at 23,600, then we have a strike price of 23,650 23,700, 750, and then on the lower side we have 23,550, 23,500. So we have a 50 points price difference for strikes. So similarly we can have a different strike prices for different asset classes. Like for Reliance it could be different, it could be on a 10 or a 20 point difference. So each strike price is different for different asset classes or different contracts. Now next is the premium. Premium is the current market price of the option contract itself, that is paid by the buyer. For example, Nifty is trading for example 23,600 is right now the coming price is the current price, and for example 23,700 is trading at for example $50, 50 INR. So you need to know that this is a premium that you are gonna pay. So this is the premium amount that you pay upfront to exercise a call option. Like I am talking about 23,700 call option, it is trading at $50. Of course this is all of a hypothetical example, the real prices could be different. I am just talking about the premium, how it usually works. Okay, jumping on to the next slide, the matrix of power and obligation. So usually you already know that there are call option and then there is a put option. So in call option there is usually one is the holder and another is the writer. So holder is another name is called as buyer, and for writer we have another name as seller. So once we exercise a call option, so what does it usually give it to them? It is a right to buy, and what it usually caps is a risk of amount paid. For example, like 23,700 I quoted you the price as 50 INR. So once you pay this 50 INR for the multiplied by the lot size, for example 65 for Nifty, 65 into 50, the amount that you pay is the only risk that you hold. So the buyer of call option is just having the risk of that. Similarly, if we talk about put option, for example in our exam 23,400 PE is quoting at again at 100 INR. So there will be 65 into 100. This is the maximum loss that put buyer can be can assume. So this is the initial risk. Now talking about the writer. So writers are usually like the most of the people are having a big capital. Reason being, they require a huge margin to sell a contract. So I am not quoting it exact margin, but usually a margin for any of the Nifty contract is more than I may be wrong, but it could be greater than 1 lakh as well. So this is the margin that you require to sell. So there has been an obligation to sell. For example, the Nifty price goes above for 23,700, it goes above 23,700 by the time of the expiration. So what it happens, you have the seller would be carrying the unlimited upside risk, because the $50 INR would be increasing up to maybe 100 or maybe to 150 as the price is increasing toward 23,700. So and if it goes past 23,700 like for 23,850, then you would be assuming a large losses. So theoretically there has been an unlimited upside risk for the seller, and similarly for the seller of put option, they carry a substantial downside risk similar to what we have discussed in the upside risk. So this is the matrix and power of obligation of the different call option and put option. Now there has been two mechanisms usually followed in the options. In India we usually have the European exercise mechanism. So American is actually writer is subject to assignment at any point before the contract expires. But in European style, there has been the writer is subject to assignment only during the specific exercise period. In India, as I mentioned before, there has been European style. So you need not worry about what is American style and what is European style. So European style is the one that is being followed in India, and that is why we have this PE and CE. So the E stands for European. Now the equation of premium. So premium usually consists of two things. One is the extrinsic value and second is the intrinsic value. So intrinsic value is a real payout, that is in the money if it is exercised immediately. For example, if the Tesla is trading at $330 and you hold a $300 call, the intrinsic value of that call option or the premium is $30, and out of the options would be having a zero intrinsic value. Similarly, extrinsic value is a speculative premium, the additional cost that the traders usually pay for the future intrinsic value before expiration, and that is the premium minus the intrinsic value, which is the extrinsic value. So we will be deep diving it into the later part of the video. Now, extrinsic value. What is extrinsic value? So it consists of two items. First is the time value and second is the implied volatility. So time value is the options with more time up to expiration command a higher extrinsic value. Why does it happen? Because a longer timeline usually provides a greater statistical chance of moving the underlying to move to profitable situation. So more the time, then the more is the value of that contract, of the extrinsic value of the option contract. Alright. Similarly, implied volatility. Usually higher expected volatility inflates extrinsic value. Why does it happen? Because there has been a greater chance of price swings, making the option to be more attractive. Now let's define it on a example way. Then for example, Nifty next week 28th July expiry, 23,700 call option would be trading as 50 INR that we discussed, and of course this is an hypothetical figure. 23,700 for the next expiry, next weekly expiry, like for example it would be on 4th of August, would be trading at around maybe 150, because it is a larger time frame that we have, so it has a more extrinsic value in that front. Now moving on to the Greeks. So a lot of Greek values that you have heard might be on different other videos, but all of these values or the Greeks are the sensitivities of the price. The option price or the premium usually are defined by all of these Greeks only. So we will be discussing about all of these Greeks in detail in the next part of the video. This video is just an introduction of all this. So in any of the platform that you are gonna use for option trading, you will be able to see, okay, these are the Greeks that we usually have. So let's understand what is delta. So delta is the sensitivity to the underlying price. So underlying how it is being moving is defined by delta. For example, it is 0.2 delta, we have 0.3 delta, so it ranges up to 1, and then it can increase as well. So second is about gamma, which is sensitivity to delta. What is the rate of the change of delta? And it usually, we have heard in many of the market videos or on a business channel, the people who are very familiar with options must be knowing about it. Gamma risk, this is the term that we use. So gamma risk is usually prevalent in the later part of the expiry, meaning once the expiration is being day, like for 28 July, the 28 July and 27 July would be the gamma risk period, because as you move closer to the expiry, gamma risk inflates. Alright. Third is the theta. So sensitivity of passage of time is the theta. This is the most critical and important Greek for the option sellers, because usually they profit from the theta decay only. Fourth is Vega. Vega is sensitivity to implied volatility. There has been volatility and then we have the Vega, which is the metric or the sensitivity analysis to check okay, how the implied volatility is. Okay, the next Greek is rho. Rho is a sensitivity to the interest rates. Usually we do not discuss about rho because it is not less prevalent, and usually people do not usually look out of this metric, because most likely delta, gamma and theta in Vega are the ones that usually decide the on a better scale. But rho is also an first order Greek, but it is not yet most utilized or much talked about. Next is about, let's deep dive into delta, gamma and every other Greek into detail. So as we mentioned about delta is actually a velocity measurement. Like you have a car, so you have the odometer, so you can assume that delta is an odometer for the car. So it measures the price change. For example, $1 move in the underlying asset, and then we would be having a 0 to 1 for calls, and then it is having a 0 to -1 for puts. So traders usually use a delta as a proxy for probability. A 0.25 delta is a 25% of chance to moving into the expiry. Alright, so this is how the delta moves, and as I mentioned, it is can be mentioned as a odometer to the car. And now second is the acceleration, so which is the gamma. So this is the second derivative. It usually measures on how fast the delta is moving, or the speedometer or odometer is moving. Gamma is usually highest in exactly at the money, because the at the money options is providing the highest volatility as well and highest movement. The reason is combination of all the Greeks, delta, gamma, rho, all of these usually come into play on any of the premium contract, but gamma is usually prevalent in the later part of the expiry. Now the next one is theta. As we mentioned that this is the this is a thing that usually is made interested by the option seller. They usually look out for this. So theta measures the sensitivity of the derivative to the passage of time, and all else being equal, extrinsic value bleeds away daily. So for example, Nifty contract, as I mentioned, about 23,750 INR is the price. Tomorrow on Monday, then on Tuesday it would be expired to 0 if the Nifty stands at 23,600 only. Reason? Because the price did not move to 23,700. For that expiry, the theta decay happened on that day of the expiry, and it went to 0. So long option inherently have a negative theta position. Alright, so this is how the theta is coming into play. And 23,800, 23,900, all of these expiry, all of these call options would be decaying to 0. Reason being, the Nifty has expired to 23,600. So all of these out of the money options would be having a 0 value now. Okay, moving on to the Vega and implied volatility. So implied volatility is there are two metrics to implied volatility. First of all, one is the historical volatility, which has all the records. This is an yearly measure of securities daily price fluctuation. In this Indian stock market context, we have the India VIX, which is the historical volatility. Then we have the implied volatility, which is usually that market expectation of future volatility, high VIX, and then we have the high IV of different options contract as well. Alright, so different option contracts have IVs of them, and then this is tracked by Vega. So this sensitivity metric usually measures on amount of money of an option gains as implied volatility, and it usually rises and falls by exactly 1 percentage points. Now moving on to the next Greek, Greeks are over. We are not discussing about rho. As I mentioned, it is not particularly used. Next is about the strategy profile that we are gonna discuss in this video. We are not discussing on all of the strategies we have. There are a lot of strategies, and people have done a lot of research, and they have created a bunch of strategies of their own as well. I mean, there are a multiple of credit spread, debit spreads, or naked. The baseline is that, but on how they have defined their risk and then they have different kind of shapes. We will be discussing upon different other videos about it, but this is how the people are evolved as well. All right, so we will be discussing about covered call right now. So for example, we have 100 long shares. Let's take an example as well. Let's take about as Reliance as an example, and let's suppose Reliance is having 100 as a lot size as well. So what we have done is we have shorted one call, we have shorted one obligation basically. So what it happens is Reliance is trading at, for example, 1300 INR right now, and then we have shorted 1400 call option, and it is maybe trading at 80 INR. So what we will be receiving, 80 into 100, that is 8000 we will be receiving, and we are already holding the long shares. So what we have done is we have assumed that the risk of Reliance not moving 100 points. All right, so we do not expect Reliance to move 100 points within this expiry. So if it is moving, then we have to exercise that call option and we have to buy the shares. All right, so if it does not move to 1400, then 8000 is a profit for us. So this is how the call or covered call usually works. We are not assuming the share to move in the favorable direction, that is the upside for call option, and then this could be on the put side. We have unsecured put as well, secured put as well, which we do on the negative side or the bearish side. So covered call we discussed. So this usually provides a premium income to the people who usually have holding the shares, and they do not expect the share price movement within this expiry period, so they can generate a simple income for themselves. So I have just talked about Reliance, but it can be done on any of the F&O stocks in Nifty or 500 or Nifty 50. So what could be the outcomes at expiration? So there could be only three options that can happen on expiry. So it is being written as expiration Friday because this slide deck has been prepared American style, but it is, if we talk about Indian style, it would be expiration or usually on Thursday of, if we are talking about a month, so it would be last Thursday of the month. So in our example, for example, the Reliance goes above the strike price 1400, then we will be keeping the premium, and then we have to called away mean you have to buy the shares. So premium you will be keeping, and then capital gains as well. So upside is usually cap, and if the stock stays flat at 1300, then the option expires worthless. You have to keep the premium and then retain the ownership of the share. This is the best situation. And stock falls below the strike price, option expires worthless. You keep the premium, but you suffer the losses that has happened because of the downside. All right, but what you have got as a downside protection is that the premium that you have received. All right, so now we have to discuss about some of the hidden metrics, or hidden mechanics, that is the taxes and dividends. Dividend risk. So option buyer usually have deep in the money calls early to capture the dividend. As the stock price ex-dividend date approaches, the covered call writer risk losing the shares before the payout. And tax strategy is covered calls can defer the tax event. For example, holding the XYZ stock or the Reliance stock in November, writing a covered call in January expiry would be allowing the seller to potentially delay the capital gains into a completely new tax year. Alright, so this is an important, since I told you this is prepared as in the context of America. So in our case it would be March, that is the closing period. So in our example, let's take February as November, like holding a profitable stock in February and then writing a covered call in May. So this would be capital gains would be transferred to the next financial year because we have a financial year starting with April. All right, so structural hazard. Usually once people are having an uncovered or the naked positions, they have an indefinite risk profile. So usually risk is undermined by a lot of people. So whenever we have a naked position, you have to assume that there could be unlimited risk theoretically. all right, and then there could be some margin call danger as well. So if the price of the asset moves against your position, then the broker requires you to add a margin payment. You have the penalty as well. So you need to keep in mind, because other, if you don't pay up the amount, penalty would be levied, and then there could be the liquidation of the contract, and then you can face some losses as well. Next is about unified option framework. So we talked about a lot of things today. We talked about underlying price, we talked about passage of time, we talked about the market sentiment, all right, and then we have telemetry and filters, what we call as the Greeks, the delta, gamma, vega and theta. So all of these define the intrinsic and extrinsic value, and then that is converted into market premium. So this is all about the option machine that usually, so prices are usually fueled by the intrinsic value and then the human expectation, that is called as the extrinsic value, and it is precisely being measured by the Greeks and deployed through the strategical architecture, but to shape the financial outcomes. That is what the traders usually do, who are into option trading and who have a greater knowledge about on how the Greek works. They usually profited from them. So this is the video that we have created for option metrics, option framework. If you like the video, please give some thumbs up, comment on what you want us to cover next, and what is the thing that we can improve of as well. And thank you so much for watching this video, and please subscribe to Market Decoded. We will be discussing more of this stuff in the later part of this in coming weeks. We will be discussing about a lot of topics, but it would be very helpful if you could provide us with the context of what you want us to discuss, because this is how we will be knowing about you. All right, thank you so much and have a nice day. Bye.